Welcome to OJM's monthly webinar series. Today we will be delving into taking a look at the evolving financial pressures and how they may ultimately impact your individual retirement. Before we dive in here, just a few disclaimers slides in terms of background on OJM Group specifically. We are high level, we are a SEC RIA registered firm. Also wanted to, before we jump in, just make an offer, and we will do this again on the back end of the presentation, but an offer to the OJM materials. They, again, are free to all attendees viewing the webinar today. Specifically, you can see some state-specific books for doctors specifically. That's California, Georgia, Ohio, and New York as well. We also have books specifically for orthopedic surgeons, and a new book just came out recently in June for dermatologists. And we also lastly have the fortune building book for business owners specifically. So topics for discussion today. We're going to take a look at the risks and the ever-changing retirement landscape. We're also going to dive into the benefits of saving early. Now, some folks might be a little thrown off by that in terms of maybe you're a little older than some of the perfect age to start saving, but it's never late, in my opinion, to start saving, so we can talk through some of that. We're also going to look at the importance of asset allocation and diversification from an investment standpoint. And we're also going to dive into market timing. We're going to talk briefly about market timing in terms of can it work, does it work, just look at some of that throughout history just to kind of help highlight or illustrate a few points there. So let's start off by just taking a brief glance, and we're going to mention these, and I'm going to briefly kind of mention the parameters surrounding these different risks, but we're going to mention these 7 risks, and really the entire presentation is centered around discussing how these risks may have been, just how the changing landscape around these various risks in terms of as folks get closer to retirement or are planning retirement today. So as you can see, we'll start here at the top right in terms of the longevity risk. This really, again, is pretty self-explanatory, just the risk of retirees outliving their portfolio. And really the reason this is kind of a concern today maybe than previously, people are simply living longer. We have some statistics here from the Society of Actuaries that say, for a couple age 65, there's a 25% chance that one of them will live to age 96. So that right there is a 31-year time horizon. So that time horizon, the length of retirement, has really lengthened, and it's really impacting folks today. So again, we're going to take a high glance at that. Next, we're going to look at solvency risks. Problems here in terms of from both the employer side as well as government issues. You have Social Security, Medicare in there, and they're in a situation where, looking 10, 15, 20 years out, they may be forced to reduce these benefits over time in terms of the dollars coming out of those sources. And you have on the employer private side, you have pension plans, a lot of default issues recently. Look at some of the state levels, such as Chicago, are having big issues with their pension systems. So if they don't all default, there's certainly going to be, or potential to be, reduction in benefits. Savings risks, again, I briefly alluded to this, but most people just simply aren't saving enough for retirement. Just a few things to highlight that, and we'll have some we'll have a graphical slide to show this, illustrate this. But third quarter of 2005, so about 10 years ago, the personal savings rate reached an all-time low of 2.2%. We saw this rebound quite significantly as we got through the financial crisis of 08-09, picked up to 8.6% in the fourth quarter of 2012. That's really, again, kind of a function of the financial crisis, as it really forced the consumer to take a closer look at their spending habits and adjust accordingly. And now we've kind of leveled back down to a reasonable 4.6% rate at the end of the fourth quarter of 2014. Moving on, we'll take a brief look at inflation and discuss the impact or the erosion impact that it can have on the value of your investment returns, right? Really at a high level, you're trying to combat the sometimes extreme fluctuations of the stock market. Early on, a lot of retirement portfolios, as they get closer towards retirement, are going to have a slant towards fixed income investments. But we're going to look at how those fixed income investments versus stocks have kind of played a role over time in terms of the value of those investable asset classes. And then really today we have another driving force here that's really kind of new in terms of healthcare costs. They've really jumped up to 3.6% annually from 1995 to 2014. So that 20-year time frame, we've seen a 3.6% increase annually there. So how that impacts your retirement. We're going to look at the market volatility in terms of how it may cause your portfolio value to fluctuate up and down. Really, how is this important in terms of just before someone retires versus during retirement, right? If you have a market drop or correction, if they occur early on, or even, again, just prior to retirement, the portfolio might not be able to have that cushion, the added cushion there to withstand those systematic withdrawals, which we'll touch on here in a few points. So how does this alter your lifestyle in retirement? Do you have the necessary income that you desired? And how does that impact your overall quality of life? We'll also take a look at retiree spending risk. This is kind of on an individual basis, as some of these are. So think about your personal situation as we kind of work through some of these slides. But what level of pre-retirement income will people need in retirement? As an advisor, this is something that we constantly get from clients. They just don't know how much is enough in retirement. So trying to get to that number, or at least plan and have a plan in place, a process in place, really helps there. We kind of typically start, hey, let's do an overall assessment of the essential versus lifestyle expenses in retirement, incorporating some of the healthcare numbers we talked about as well. And then lastly, the withdrawal risk. Retirees really need guidance on what withdrawal rate may be sustainable over a long retirement, right? Certainly you have some issues that come into play in terms of the qualified retirement accounts. You have your RMDs, your required minimum distributions. But aside from reaching 70.5 when you have to start taking those, where do we take dollars? What accounts do we take dollars from? How much? What's that sustainable level of your withdrawal rate? And again, depending on the size of your portfolio, this could mean your retirees are pulling out more than they need, in order to satisfy that RMD. And really, again, in doing so, you're paying unnecessary taxes on the larger amount that you don't necessarily need. So shifting gears here, this slide hopefully illustrates how the burden is shifting to individuals in terms of covering their living expenses in retirement. Generally, think about it. If you don't save enough for retirement, you really have three options. You can retire later, push that retirement out further, which certainly some people would be fine with, but most want to retire sooner rather than later. You could retire in a much different lifestyle than you had planned, in terms of some of the expenses you wanted to have, or some of those lifestyle expenses in retirement, or the last, don't retire at all. So again, let's take a look at this chart, which is again based on the analysis by the Social Security Administration, and how quote-unquote guaranteed income sources have shifted over time. So you can see in 1974, 56% of retirement income came from federal sources, Social Security, and private pension plans. By 2010, so 35 years later, that number dropped to 36% of retirement income. So really making the average retiree responsible for 64% of their income in retirement. Without a pension plan source, you can see that number jumps to an alarming 81%. So let's fast forward into the future. By 2030, it's projected we can see that only 24% of guaranteed income is expected to come from Social Security and pension plans. We already briefly alluded to, the size of Social Security coming down. People are living longer, harder to pay out that benefit for as long. But also the evolution in terms of employers no longer providing those defined benefit type pension plans. So again, what that just means is the average retiree will really have to rely on their own personal savings, as well as the potential to actually have to work during retirement. So here's just, I just mentioned that in terms of a lot of employers are beginning to cut defined benefit plans. You can see pretty drastic in terms of, back in the 80s was really the height of employer defined benefit plans. Basically, you think about a traditional defined benefit plan. Basically, the employer was taking on all the risk of the plan. The retiree didn't really have to save or contribute any dollars to the plan, other than just working there. Every plan's different, but really just having the hours and the history there at the company. So you can see in the 80s it was almost towards a little over 175,000. By 1999, early 2000s, that number dropped below 50,000, and it stayed there, if not gone a little bit lower since. Again, the reason why is a lot of folks have replaced those the traditional defined benefit plans with defined contribution plans. And that shift, again, is even further shifting that burden to those from the employer to the employee. And in many cases, you see the employee just does not fully understand what is really required to implement an appropriate retirement savings plan, and therefore just doesn't even take advantage of defined contribution plans. Again, this slide is kind of showing you, on average, most Americans really are not saving enough. Again, until recently, you can see the savings rate has been falling for more than 20 years. People just aren't saving enough. Again, I briefly touched on the numbers, but Q3 2005, you can see the all-time low was around 2.2%. It peaked at about 8.6% and is back down to 4.6. So there's still, we've come a little bit back in terms of, we're kind of in between the lows and the bottom in terms of this decade, at least since the 2000s. So that's a good sign that people seem to start recognizing this. Hopefully, the more and more people talk about it, the more they realize they need to start saving, or at least putting an emphasis in saving for their retirement. I think, personally, I think it's somewhat of a cultural phenomenon. You have baby boomers, some of those the older generations, they lived through the Depression, they lived through, World War II. So they understood the importance of saving, because if you didn't, pretty drastic impact if you didn't have the money there. And I think today you see some issues with people taking on too much debt, credit issues, really overextending themselves. You have, again, aside from the unlimited access to credit, you also have a younger generation that seems more focused on spending today and, kind of getting that benefit today, and instead of saving for those future needs. They just don't necessarily think, they're not wired the same. So we've seen that shift in terms of people just are not saving enough. So I did want to, we know people aren't necessarily saving enough, so let's kind of talk about, from a time standpoint, again, the earlier you can start saving, the better off you're going to be. This slide here just illustrates that point on a dollar basis. You can see there on the bottom left, at age 25, if you start saving $381 a month through age 65, and these all are through age 65, and this is assuming a 7% compounded annual rate of return, you'd have $1 million by that age 65. Take that all the way to the right of the graph, by age 55, if you wanted that same $1 million, so by age 65, so 10 years instead of 40 years, you'd need to save almost $5,800 a month to achieve that $1 million. So again, just trying to illustrate that pretty drastic change in terms of, yes, the earlier you can start, the better off you're going to be. And really, the earlier you start, the less of an impact from a cash flow perspective that this monthly savings has on your personal situation. So now I kind of wanted, we understand people aren't saving enough. I wanted to kind of jump into, you know, what, if you do decide to save, what are some of the options out there? What's that look like? How does that help you? You know, how do those different investment options out there help you reach retirement? You know, there's different characteristics in terms of from a risk-reward, risk-return perspective, how those play into an overall portfolio. So you can see on the left side, these are the investment options on the left side have less investment risk and more inflation risk. On the right side, more investment risk and less inflation risk. So we'll start there with short-term investments. Most of you are probably familiar with those. You're looking at money market, cash investments. These really are considered the least risky of all three that you see there. However, they also tend to produce the lowest returns over the long term. And again, typically more people like to get more conservative as they get older, moving from stocks into bonds into short-term investments. Bonds, fixed income investments, generally less risky than stocks, can kind of help offset some of the investment risk that stocks really create. Again, bonds are really glorified IOUs, right? Now, the potential risk here and return on bonds, it's pretty moderate. You know, it's lower than stocks, but it's certainly higher than those cash investments. Generally, you know, you may have heard a lot surrounding right now in terms of when the Fed, the U.S. Fed, does to start to raise interest rates. That's going to have an adverse effect on the price of bonds. So when interest rates rise, price of bonds fall. So really, a lot of folks are concerned with their fixed income kind of moderate risk bucket, if you will, because they think that, you know, rising rates are really going to have a huge impact on the price of their bonds. Now, certainly if you hold those to maturity, you're going to get your money back. Not as big of a deal, but something to keep in mind. Again, we want to highlight the importance for retirees to stay diversified. Now, I just mentioned, you know, interest rates are going up over the, you know, maybe by the end of the year, maybe into 2016. However, you don't want to eliminate one asset class or another from a portfolio at a given time, because hopefully what this chart does is help illustrate the volatility from one asset class to another over a given time frame. You know, often one year you may see an asset class as the top performer, however, in the next year it's the worst. You know, let's look at 07 to 2009 scenario. You can see 2007, for example, emerging market equities, emerging market stocks were up almost 40%. The next year they were down 53%. And we'll touch this on the last slide, but often a lot of folks are late to the party, and often, you know, money piles into those asset classes almost when it's often too late. You know, you're kind of too late to the party in terms of you didn't really get the entire 40% in 2007. Maybe you got half of that performance, but often you're invested the entire 2008 scenario where you lost 53%. So you really didn't get all the upside, but you got a lot of the downside. And we'll talk about how that, from a market timing standpoint, impacts a portfolio. But, you know, we prefer to kind of stay in that middle area of the chart. You can see kind of that overall asset allocation. You can see the percentages down there in the disclaimer below. But really trying to limit the overall volatility of a portfolio. We don't want to be the best performing asset class, and we don't want to be the worst on any given year. We think over the long term that helps smooth the return stream and kind of take out some of the volatility of the market by again, staying diversified across different asset classes, not making calls, all-in calls one way or the other. I wanted to further highlight this point by just showing you, and this is pretty timely in terms of most folks listening to this discussion had dollars invested in the market in, you know, early late 2007 into 2008, 2009. As we've seen, things have recovered since then, and really the U.S. stock market has done, we're up over 200% since then. But hopefully this chart helps illustrate that a more diversified portfolio is actually going to recoup your losses sooner than an all-stock portfolio. A lot of people, this is when I always like to kind of just simple math here. A lot of people don't realize, okay, let's say, looking back to that last chart, you were an EM, emerging market stock investor, and in 2008, unfortunately, you lost, we'll just use for calculation's sake, 50%. Let's say you lost 50% of the value in 2008. Well, if you wanted to get just back to even, you'd need not a 50% return on the dollars you now still have invested. You need a 100% return, so double what you went down in order to get back to even. So again, when you stay diversified from an asset class perspective, hopefully it limits that downside. So maybe you were down 25 instead of 50, and now to get back to even, you only need a 50% return, not 100. So you can see up on the top here, the blue line is a 40-60 portfolio, 40% stocks and bonds. The 60-40 is 60% stocks, 40% bonds, and then the green line is the all S&P, all U.S. stocks, essentially. You can see that the portfolio that recouped or got back to even the quickest was actually the bond portfolio, the more heavily weighted into bond portfolio. That was by November of 2009, that portfolio recovered to even. It wasn't, the next portfolio was about a year later, the 60% stock, 40% bond portfolio about a year later recovered back to even. It wasn't until March of 2002, so almost 2.5 years after the fixed income, the heavier weighted fixed income portfolio recouped back to even, before the S&P, the U.S. markets recovered. And again, I highlight this because it's important to know, it's important not to put all your eggs in one basket. I'm sure everyone's heard that over and over, but it really is important. And again, this is important, especially for some of our clients that we're talking to that are really trying to chase those returns, really, of the U.S. stock market. Again, the U.S. stock market's been up over 200% since the financial crisis. So it's very hard for folks not to want to push dollars towards that asset class, that market that's doing the best. It's just how we're wired. It's how we're psychologically wired. Another way to kind of illustrate this point in terms of why it's unwise to extrapolate performance trends far into the future, hopefully this helps further that point. You can see back in the late 90s, early 2000s, the asset class that did the best was the U.S. markets, and this is pretty timely for what's going on today as well. But almost up 16% from that given time frame, whereas you look at emerging market stocks, had a pretty tough, from a performance standpoint, negative 4.1%. So what unfortunately happens a lot of times is you see a lot of investors, hey, get out of emerging market stocks at the worst time when they've already lost money and into U.S. stocks. And let's see, you can see what happened over the coming time frame from 2002 to 2007. Emerging market stocks rebounded and went on quite a run from a performance standpoint, up 29% annualized over that period versus just 6% in the U.S. stock market. So again, really just unwise to extrapolate kind of what's happened recently into the future. And I'm going to jump once, we'll get to the market timing implications of that in terms of just staying invested over the long term and how that helps. But I did want to again highlight, I know we kind of mentioned inflation and how that has an impact on a client's perspective. So what this chart does is it's an 89-year examination of past capital market returns. So from a historical standpoint, the bottom left, you can see all of those started with $1. So if you invested $1 into those 4 traditional asset classes, what would the value of those be? And this chart goes through December 31st, 2014. You can see that large and small stocks provided the highest returns and largest increase in wealth over the 89 years. You can see also fixed income investments provided only a fraction of the growth provided by stocks. However, we just talked about risk in the last couple slides here. The higher returns achieved by stocks definitely are associated with much greater risk. And you can see the volatility in terms of some of those returns. It's a much smoother ride on the bond side. You can see that. The fluctuations on the small and the large stock side, you can see some bigger gyrations up and down in those markets. You also can see what hasn't done very well, unfortunately, is Treasury bills, as well as really, again, inflation. You can see the value of $1 in the early 20s is now really the value of $13. That's just simple inflation. That's your purchasing power risk. So again, we understand that stocks, from a historical standpoint, have done better than bonds, cash over the long term. However, that comes with risk, so it's a balance of risk and return. Here's the last kind of slide I wanted to discuss in terms of, from a retirement perspective, a lot of folks we talk to, again, I've been hammering it here on these last few slides, try to time the market either on the down end or the uptrend of a market. And really, investors who attempt to time the market, in our opinion, run the risk of missing periods of exceptional returns. And what that does is that's going to have significant adverse effects on the end value of your portfolio, the end dollar amount that you have. So this graph, you can see the top graph illustrates the risk of attempting to time the stock market over the past 20 years by showing the return investors would have achieved if they had missed some of the best days in the market. Then the bottom graph is just going to illustrate those actual daily returns for all, and this is on 5,040 trading days, as you can see. So let's look at the top chart in terms of what those numbers are. So investors who stayed in the market for all 5,040 trading days achieved a compound annual return of 9.9%. Pretty darn impressive, just staying invested. That same investment would have only returned 6.1% had it missed just 10 of the best days of stock returns. So just 10. Take that a step further, the most extreme case. Missing the 50 best days, or really what equates to less than 1% of the total days, and total investable days, the investor would have produced a loss of 2.2%. So pretty extreme. Although you can see the market, again, on the last slide, it really has exhibited tremendous volatility on a daily basis. You can see some pretty big swings both up and down from the chart below. Over the long term, stock investors who stayed the course have been rewarded. Okay? Now, I hope this graphically illustrates that. Again, just 1% was 50 days you missed. You had a negative 2.2 return. So just staying the course. Often, again, in finance, it's a lot. There's been a big shift in terms of how behavioral finance impacts someone's retirement, and this, to me, is key because a lot of folks just are unsatisfied with, again, and I hate to say this, but doing nothing. Often doing nothing, not touching your portfolio is better than trying to make these changes in the short term because, again, you can see the drastic impact they can have. So that concludes the discussion here today. I did want to, again, briefly kind of to conclude, just highlight how OJM works with clients, kind of what we do from our planning side. You can see in terms of we're a multifaceted firm. We have 1,000 clients across 48 states in the United States. We do work with folks in all these planning areas you see above, mostly on a consultant basis. And that includes asset protection, tax reduction, corporate structure, benefit planning, retirement planning, insurance, as well as wealth management. I primarily am on the wealth management side, managing, individual family money. However, we do understand, as you kind of seen the evolution of this presentation, a lot of this, in terms of your financial well-being, all has a role. And it all has a role not only from a high level, but also how it impacts, again, me specifically on the investment side, how we build out a portfolio. Every person's situation, circumstances are fairly unique, and what that means is every person needs to have a portfolio built to those unique circumstances. We've kind of highlighted earlier, as you get older, the emphasis is maybe less on growth because you've already accumulated so much wealth, and more focused on, income. What income can my portfolio pay me? Hopefully it can pay you enough income to sustain the lifestyle you want without having to dip into or evade that principal. So again, these are just some of the other areas, consulting areas, that we work with clients. Again, I mentioned a few of these points here. We do work with clients both on the corporate practice side as well as the personal side. And lastly here, again, to highlight, you do have the option to get a free copy of not only any of the For Doctors Only books. You saw the state-specific books. We also, and the new dermatology book as well. We also have the Fortune Building for business owners and entrepreneurs. So although our focus niche is certainly physicians, we also do have many clients in that business entrepreneurial space as well. Or again, any of the other books, again, free copy. There's certainly an option to get a free copy here of those as well. You also have the option for a free consultation, so you can have a discussion with one of the members of our financial planning portion of the firm. And that could, again, that's wide ranging in terms of some folks just engage us for maybe asset protection tax purposes, or maybe just, hey, I want to, Adam, will you take a look at my overall investment portfolio? Certainly there's some of those one-off planning ideas, but certainly just getting on the phone and talking to one of our planners to see where some of those interests may lie, we offer that up as a free consultation here just from listening to the webinar. Or certainly feel free to contact myself directly. You can see the number, the 800 number below to the office, as well as my direct email. One last point on the book side, feel free to visit our bookstore at www.ojmbookstore.com and use the promo code WEB0615 at checkout, and that's how you get the free copy of the book. Thanks again for your attendance today, and looking forward to speaking with you in the future.